January 24th, 2025. Today we basically had a triangle early in the day, and the triangle ended up getting a downside breakout, and we basically got a bear trend for a couple of legs down, and then we went sideways for the remainder of the day. Overall, coming into the day, we were very close to the all-time high. I did think we would get there. Obviously, when we got 1, 2, 3, I started to think we were probably just going to get somewhere around the all-time high. I didn't know what we would do once we got there, but obviously that did not end up being the case. We actually ended up forming a double top with the all-time high. And on the daily chart, this is some sort of bear bar closing near its low, right? So a little bit of less of a chance that that obviously we go straight there now, considering we have a decent looking bear bar on the daily chart now from today. Bar one, a bull bar, but a large tail on the top. The rally, the 78, is going to get a second leg up, and one could be that second leg up, or we could get follow through, and that could be the second leg up. Really don't know yet, but we're probably going to go a little bit more sideways up, at least for a couple of bars. Two, a follow through bar, good for the bulls, closing near its high. Can you buy above two? I mean, I probably wouldn't. I try not to trade the first 6 or 7 bars of the day because there's just too much volatility, but it's not unreasonable to buy, taking a chance we just get a vacuum test of the all-time high. Three, a doji bar. So it's a pause bar. We have a pause on one, and then a rally on two, a pause on three, and then a rally on four, and then another pause on five. So after the large tail on four, yes, we might need another leg up. But what do you notice about the 3 pushes up? It's a wedge. It's 3 pushes. So we have 3 different pauses. So I think we're probably going to be a little bit more sideways to down for at least a couple of legs. Five, like I said, the third leg up, and then 6 buyers below 5 initially, and probably going to get a second leg down. Big outside down bar on 7. 7 is big enough that we should get at least a second leg down, but I'm not sure how much lower we're really going to go. It's good for the bears, but you're selling against a ton of bull strength. We've had, look at yesterday, right? Look at the final 3 bars of yesterday. So it's really a little bit difficult to sell and hope you get a big move down. With that being said, it's going to get a second leg. So you could sell the close of 7. You could sell the 6 low during 8. 6 is the breakout point. So we're probably going to try to test it. And you can see we end up getting a doji bar on 8. It's a bull doji, so disappointing follow through for the bears who took the short, but we're still always in short. 9, buyers below 8. But again, still expecting 3 legs down since it's a big enough bar to clearly make the market always in short. 10, a bull bar, a high 2 essentially, but not really that good. 11, buyers below 10 initially, but still always in short. 12, I still think we're always in short on 12. Not really any reason to buy, but it is 3 legs down. 13, a reversal up, but a large tail. I'm not really willing to buy up here. Again, still always in short, but it looks like a leg in a trading range is the thing to keep in mind. This doesn't look like always in short in the way that it's going to be a big bear trend. It looks like it's just a leg in a trading range. 13, a reversal up. As I mentioned, I think I was on 14. So yeah, 14, big outside down bar. Again, just a 4th leg down. 15, a reversal up. After 4 legs down for the bears, we're probably going to get at least a couple of legs up. Leg counting is extremely important. 16, consecutive bull bars, possibly a nested second leg move. Rally on 15, pull back 15, rally on 16. So 1 pullback 2. Good for the bulls. 16 is big enough for a second leg. So the fact that 16 is big enough for a second leg makes me less open to selling. I know that this is a tight channel down and we're overall a little bit more bearish, but I'm not going to short after I get 15 and 16. To me, this is starting to become the buy zone. It looks like a trading range. It's the best bull bar we've gotten since we became clearly always in short. I still think that we're always in short on the close of 16. However, that could change pretty soon. 17, a bear bar closing near its low. Good for the bears, maybe going a little bit lower, but I think the big issue is that 15 and 16 is going to get a second leg. 18 has a lot of overlap with 17. So if you're selling down here, you're basically selling, taking a chance you're going to get a collapse below and some sort of measured move down. You can't really sell below 18. Well, it's really not a great trade because you're selling the bottom of a bear channel. And after 15 and 16, that's going to get a second leg. And we already have 3 or 4 legs down for the bears. So 18 is really not a very good trade. But if you did take it, your expectation should have been 19 looked something like bar 30. You want 19 to just be a giant collapse. And instead, you got a doji bar. So what are you going to do? Well, you're going to buy back shorts. And that's exactly what happened in that cost 20. 20 is a good second reversal up. And 16 is a big enough bar that we're probably going to get a second leg up from that. And we're going to get a second leg up from 20. So 20, I think, reversed the market to always in long, but it's not great, right? You're still buying against a decently tight bear channel. And if you're buying above 20, you're buying the top of this tight trading range. And basically towards the middle. This is the middle of the overall trading range. So it's really, the big bar, big risk. You can buy the close of 20, but it's just not really an ideal trade. A lot of traders preferred to buy a pullback. You can see the bar 19 high. They bought the breakout point for a scalp. 21, a disappointing follow through bar. Not that surprising considering the big risk of 20. A lot less traders willing to take it. Instead, traders buy below 21. A reversal up, a bull bar, but a large tail 21. Large tail 22. 23, a good bull bar, but it's looking like a second leg up. So this is leg one, pull back, and this is the second leg. 24, another bull bar, good for the bulls, probably going a little higher, but if you're buying 24, you're buying the middle of a trading range. So I don't want to trade in the middle of this trading range. Certainly not on stop orders. 25, another doji bar. It's a little bit disappointing. I think we're probably going a little bit higher, but I don't know how much higher. Outside up 27 or 26. Okay for the bulls, but look at the fact that 26 traded below 25. The fact that that happened tells you that you're now entering the third leg. So do you really want to be buying during the third leg of a trading range? No, you don't. 27, a good bull bar, closing near its high. If this is going to be a bull trend, right? So if it's a trend, the leg count is less important, but this is probably a trading range, so the leg count is important. So if you're going to buy above 27, you need to have really good expectations for what you want to see out of 28. You probably want 28 to look something like bar 20, or you want maybe 28 or 29 to look something like 20. You want really good follow through. And instead, 28 is basically just a small bull bar. It closes basically at your entry price. That's disappointing. You want 29 to be a huge bull bar. And instead, it's a doji bar. So it's not surprising that bulls sold out of their longs. I did take a couple trades in here. I knew it was 3 legs up, and so I sold the close of 28. Basically, it was a third leg up, and this is, it was a third leg up, and this is a 3-bar channel, and these 3-bar channels are very, very, I'm doing research on it right now, but they're very unreliable in late legs, especially in trading ranges. So I sold the close of 28, and then I exited where my stop would have been. So had I bought this close, my stop would go below 26. Therefore, that's a logical exit. So I sold the close of 28 and I exited here during 30. And then I bought during 30 around here, basically the low, betting that the third leg, the high would get retested, but 30 closed too strong. And I ended up exiting down here. Kind of difficult to exit down here for a loss because you're probably going to get a little bit of a bounce, but you just have to get out at some point. So I ended up getting out. I basically was break even through those first 2 trades. And then I sold. Well, I didn't sell the close of 42. It's 3 strong bars, and so I thought we might get a measured move. However, I was suspicious of 42 because if 43 was a bull bar closing near its high, that's a credible midday reversal. But after 43 was a disappointing bar, I essentially sold the close of 43 and then held, and 45 is not a good reversal, so I sold more during 47. Somewhere in the upper third of 47, I sold more. So I was short here, and I was short here. The reason I sold more on 47 is because I know if 47 becomes a big bull bar closing on its high, I can just exit and assume it's a trading range. And instead, obviously, we continue to channel down. And I got out of that. It was somewhere during 54 in the lower third. My target, there we go. It was right here. My target got hit. So I sold here, sold more here, and exited here. And then I bought above 59, basically taking a chance that the always in bull bears are going to exit and we're going to get a good looking bounce and close the exhaustion gap. Obviously, the exhaustion gap with 52 and 55 closed later, but I thought there was a reasonable enough chance it would close right here. But I got disappointment on 60, so I just got out at the market and basically flat. So between these 2 trades, I was basically flat. In this trade, I was basically flat. And then I obviously made money on the 1 trade. So not all that surprising that we got a big reversal down 30. It's a bear surprise, but it's not surprising that we got it because it's 3 legs up in a trading range. 31, buyers below 30, a doji bar, and initially sellers above 30, 31. Should get a second leg down, but if you sold the close at 30, 31 really isn't that great of follow through, although you are still expecting to go lower overall. 32, a bull bar, but it's not really worth buying. We're probably still going to get a second leg. 33, good for the bears, probably going at least a little bit lower, but not really that great. If you sold below 33, your calibrated expectation is that we're going to go below 31 and you want to get a collapse down. Instead, you get a bull bar closing near its high on 34. So bears exit above 34. If you buy, you can probably buy, but it's a little bit difficult. I don't want to trade in tight trading ranges. 35, consecutive bull bars, good for the bulls, but you're buying high in the trading range. So if you're going to buy 35, you need to have really, really good calibrated expectations as to what you want to see on 36. And this is a really good example of what good traders do. I mentioned I'm in a trading room, and one of the guys in the trading room mentioned that he bought the close of 35 today, and he actually made money on the trade. And you're asking, how did you buy the close of 35 and you made money? Well, he basically bought the close of 35 because he was buying momentum. He knew he was buying high in the trading range, but he also knew that 35 moved in a very bullish way. So he wanted 36, basically right when 36 opened, he wanted 36 to race up. And instead, for the first 2 or 3 minutes of bar 36, it was stalling around the high of 35. And so he knew that if 36 was going to be a big bull bar, it probably would have started in the first minute or so. And so he ended up deciding that, there was no more momentum. It had dried up, and he exited at the market before 36 happened. So he bought the close of 35 and made money. And that's what good stop order traders do, is they have really good expectations for what they think that the next 2 to 3 bars are going to look like and how they're going to move. 37, a bull bar, it's maybe 3 legs down, 31, 36, 31, 33, 36, but it's not worth buying right at the moving average. 38, an inside pattern, 37, 38. Again, we're at the apex of a triangle at this point. We've had, if you're looking at a 15-minute chart, I was this morning at this point, but this whole thing was turning into a triangle. And when you're getting a triangle, it's better to just wait for the breakout. 39, another reversal up, but it's a doji bar, not really worth doing anything. And then 40, a midday reversal. We get a collapse down. 41, good for the bears, but a large tail below. 42, another big bear bar. So large tails 41, large tails 42, could be a parabolic wedge on a lower time frame. If you did look at 42 on a lower time frame, it had a lot of pullbacks within the bar. So that was one of the reasons I did not sell it. That's not the button I wanted. One of the reasons I did not sell it was because there were so many pullbacks within the bar as it was forming. You can see big pullback. So it was moving like a possible parabolic wedge, so I stayed out. And then 43 is disappointing. The bulls were hoping 43 would be a big bull bar closing near its high, and instead it's that. So traders can sell below 43, or they can sell below 44. 45, a reversal, but it's a doji bar. You don't want to buy above a doji. And what's the 2 to 1, right? So if you're buying above 45, here's your 2 to 1. Really not that likely that we get there, and probably way better to wait for higher probability. So 45, big bar, big risk, and a bear micro channel since 40, and a doji bar. So not worth doing anything with 45. 46, consecutive doji bars. If you bought above 45, how do you feel about 46? It's not very good. You want a better follow through. 47, another bull bar, but with a lot of large tail, so just dojis. Again, this is not good. 48, a bear bar. So if you bought above 45, how is this trade treating you so far? These 3 bull bars, or these next 3 bars, not very good. So it's not that surprising we get an outside down bar at 49, because as 49 rallied, the bulls who were buying for any reason got out. An expanding triangle on a lower time frame. But really what you need to know is, if you bought 45 and you got stopped out, you have to have better expectations for what you want to see for this trade. Because if you're going to take something like this, if 46 is not, a perfect bull bar, something like 20, then you just need to exit the trade. And that's what traders are doing on 49. Outside down 49, it's an outside bar, so it'll probably pull back first, but should go lower. And then we get 50, a pullback. 51, a bear bar closing near its low. It's a tight bear channel down, and a lot of times with tight channels, you just get kind of vacuum tests at the end of the day. And you can see that's what we ended up getting: 54, 55, 56, basically just a vacuum test down. A collapse below the bear channel, but ultimately probably will not be that successful. I know that. So for me, this is obviously 40, 51 through 54 is that 4-bar channel that I talk about, but this is not one of the spots where it's a good place to short. I instead was looking for the bar that would have made me exit had I taken the short, which was 59. So I bought above 59, taking a chance that we bounced, and obviously 60 didn't quite do what I wanted it to do. So I just got out of the trade. Basically 3 legs up, 1, pullback, 2, pullback, 3. Obviously this is another 4-bar channel, but the location is terrible. You're at the top of what's probably a trading range, probably a better fade after 3 legs up than anything. But I was not doing anything with that at that point. And then 3 legs down, 69, or I guess 4 legs down, 66, 68, 70, and 72. And then a reversal up 75. And just an expanding triangle at the end of the day, 57, 75, and 60, 65, 78. So not really worth doing anything at the end of the day. For stop orders on the day, I mean, you could buy above 20, but I think this is a trade that a lot of beginners take and they'll make a little bit of money on. But I think, continuously taking trades like this usually leads to bad habits. It's just a lot of risk, really big bar, really big risk relative to the range, and you're buying towards the middle of the trading range. So you can do it, but it's really just not ideal. It's probably better to try and buy the pullback and then scalp out. But that's hard to do. It's not a great, beginner-esque trade. I mean, you can buy in here if you know what you're doing, but if you bought somewhere in here and you got stopped out, you got to really understand that you were buying second and a third leg, and that when you get a really disappointing bar like 29, if you're buying up here, you really need this to just go and be a vacuum test, because you're trading a third leg. And whenever you're trading a third leg, your expectation should be that it rallies or it moves with your side really, really quickly. So if you're buying above 27, I'm not satisfied with 28. And if I buy above 28, I'm certainly not satisfied with 29. And you can see the bulls bought above 28, disappointed in how 29 was. They sold out of their longs because it's not the bar you want. You want a big bull bar that looks like this. And so logical to maybe sell the close 28 or 29. And then you get the big bear bar, bulls exiting longs. I would not do anything in here. You could sell the close of 42 or sell below 44, sell below 49, 51, 53, but getting late, and then obviously climactic at the end. For the daily chart, you can see we have a double top, and the second leg up is some sort of parabolic wedge. You could argue on a lower time frame. It might be an expanding triangle. I think we might go a little bit lower. I don't know how many, bulls might exit below here, but I don't think we collapse. Ultimately, we're obviously, I think, going back to the all-time high pretty soon here, maybe next week. The weekly chart, consecutive bull bars, but a little bit disappointing, right? So, when you look at this, is it going to get a second leg up? Yeah, it's going to get a second leg up. Yes, this is going to get a second leg up, but it's not by the close, it's by the pullback, maybe by the low, and then get the second leg up. And obviously, no surprise, around the low is 6,000. The monthly chart's important. The bulls want an outside up month, stopping out the bears who took the bad short. And again, I think we're going a little bit higher, but I don't know how much. All right, that's going to be it for this video.